Welcome everyone to BDO's webinar focused on professional service firms. My name is Anna Gerald and I am the tax partner leading our professional services tax team in the UK. For those of you who don't already know, BDO is a global accounting network with over $7 billion in revenues, providing auditing, accounting and taxation services in 154 countries with over 64,000 people. Today's webinar will provide an overview of the structures we see UK headquartered professional service firms operating from in the US and the relevant issues associated with such structures. We will also discuss the issues facing UK partners relocating to the US in these professional service firms, as well as US partners coming to the UK. Our speakers, Mark Walters and Andrew Harrison, work closely with our professional services team and specialise in advising on US tax matters, focusing in particular on the special combination of issues applying when UK and US taxes are involved. You can ask questions during the webinar. Please use the Q&A feature, which is in the top right-hand corner of your screen, and please send questions to all of our panellists. We will address as many questions as we can at the end of the webinar, or if time does not permit, after the webinar. We'll also record the webinar and we'll email you the slide deck as well as a link to the recording in a few days' time. This email will also include a link to a survey asking for your input on this webinar, as well as your suggestions for topics that you would like to see covered in the future. Please complete the survey as we'll use the feedback to improve our output. We will finish within the hour. Over to Mark.
Thanks, Anna. So I'm Mark Walters, and I'll set the scene of what Andrew and I are going to talk about this morning. I'm going to start by looking at some of the domestic US principles and organizations and structures, and then move on to some of the foreign entities and how they're classified and the characteristics of how they're treated for US purposes. I'm then going to hand over to Andrew, who's going to look at some of the personal residence and tax implications for partners and employees. And then I'll come back in myself to look at some of the structuring for US purposes, and then finally touch on some of the latest developments that we've seen. So first off, I'm going to look at some of the domestic US structures that apply for professional service firms, looking at partnerships, LLCs, LLPs, and so on. So let's start at the beginning, if you like, with looking at some of the general partnership principles as they apply in the United States. So everything's essentially governed by the revised Uniform Partnership Act, which sets out and has been adopted by the majority of states now, which looks at how a group of individuals gather together to form a partnership for US purposes. So that will that can incorporate individuals, other partnerships, corporations, and other associations. So within the Internal Revenue Code 761, it looks at partnership including syndicates, groups, pools, joint ventures, or other unincorporated organizations, where they venture to carry on for federal tax purposes a trade which is not in the form of a corporate trust or estate. And that all revolves around a case, 1946 case, the Commissioner versus Tower, where it sets out the principles as set out on the slide there. The intention of parties in question, fact, determined by testimony, that they act together in agreement as an entity and conduct and execute the provisions of that agreement. So the agreement forming how they work together. So partnership characteristics. The partnership itself is not a taxable entity. The partners account for their allocable shares in computing the federal tax, and we have an aggregate approach looking at all the partners together in terms of tax application. So there are several code provisions that treat a partnership as a separate entity, the entity approach, if you like, and this is primarily concerned with the basis the partnership has, basis in its assets, and each partner then has their own separate basis. So effectively the partners interest in the partnership. So for state law purposes, they're recognised as a separate entity from the members, and then we move on to there's effectively no limitation on the partners. So now we look at limited liability partnership, and the search for relief by professional partnerships encourage states to enact the limited liability partnership provisions. There are 20 states that operate LLPs, and as I said, it grew out of the desire to have that limited liability. So the revised Uniform Partnership Act 1997 states that an LLP is a partnership that has filed a statement of qualification under that Act in relation to that status in the particular state that it is governed by. So they have the basic structure of a general partnership with the features uniquely allowing the partners to benefit from the limits on the liability. The states that recognise some of the typical ones are the Eastern Seaboard states, with the exception of New Jersey, Texas, some of the southern states, and some others in the Midwest. There are variances in approach and types of business that can be conducted under LLPs, but those are the general principles. The Delaware Attorney General opinion, the liability and role of the partners in registered LLP vastly differs from the liability and role of limited partners. Where we see it in tax terms quite often is that the interests in LLPs and, in fact, in LLCs are treated as general partnership interests for the purposes of what is known as 469H2, which deals with the partner's material participation in the partnership. So if there's no interest in the limited partnership by a limited partner, they should be material. So if you've got passive activities, then limited partners get restrictions on the amount of losses they can take. But if you're an LLP, then effectively you get the benefit of that material participation, which obviously can be very attractive. Just for the form on in terms of other partnership, we see limited partners and limited liability limited partnerships, which some states accept. We'll move on to limited liability companies. An LLC is a hybrid entity, insulating its members from liability to the same degree as a corporation. And this grew up out of an interpretation of the Wyoming LLC Act and a revenue ruling 8876, where it was first recognized. And the key things here to remember is that the analysis under the Code Section 7701, conclusion was reached that an LLC lacked the characteristics that a corporate would have in two particular forms. One was that it didn't have free transferability of interests, and there wasn't a continuity of life separate from the LLC. So, in drawing on this, states' LLC statutes have all been enacted generally to ensure that they lack those characteristics, to ensure that you've got a corporate, you've got an LLC and not a corporate. And under most state statutes, they also lack the corporate characteristic of centralized control. The rules have evolved further, and we've got the check the box or entity classification rules, which from December 1996 have really further encouraged the LLC with a classification as a partnership, an association by election, or as a disregarded entity. The primary advantages of an LLC are the lack of the personal liability of the owners, members, and the LLP or an LLP may also provide some members with insulation, but you've got greater management flexibility that you can achieve through an LLC. and you can elect for someone other than the members to effectively manage the LLC. Other things we see with LLCs is that series LLCs in Delaware, it permits a whole series of ownership interests, allowing separate series of members and business purposes. So you can effectively segregate and shield different parts of what you're doing for business purposes from one another, and potentially therefore limit your liability on particular elements of the series. Some other states have tiered LLC structures, and that can achieve a similar result, but with greater compliance and other costs. Right, so now I'm going to briefly move on to foreign entities, the very things we're here about, and how they're characterized for US purposes and some of the key rules there. So that revolves around 77011 to 4 of the code regulations. And essentially we're looking at whether or not we've got a domestic or a foreign entity for federal tax purposes. So if you have created or organized an entity in the United States or any of the particular states, then you've got something that's US, domestic for US purposes. If you've got an entity which is foreign and not domestic, surprisingly, then we've got something extraordinarily that you conclude is foreign. And that's 7701A5. An extension of that, though, interestingly, is where you're organized in both the US and in a foreign jurisdiction. Then for US purposes, you'd be treated as domestic for foreign tax purposes. So an entity created as a PLC in the UK could be organized as an LLC in Delaware, and it would be classified as a corporate for federal tax purposes and is a domestic corporation for US purposes, so it's duly chartered. Entity classification is made, so importantly, the entity classification of a foreign entity is made independently of whether it's domestic or foreign. So moving on to entity and ownership. So if we've got a foreign entity, you're going to be taxed based on the source of your income. And there's two key parts of the Internal Revenue Code here, 881 and 882. 881 is income that's not connected with a US business. And we're going to look at that in a minute. That's effectively fixed, determined annual and periodic income. And then 882 is where you'll see it in a business context because it's income connected with a US business, effectively connected income. So first we look at the US taxpayer. First we'd look and see if whether we've got the US taxpayer in the ownership of the foreign entity. And the key factor there is, of course, you've got an American subject to worldwide taxation. So there's a whole raft of anti-avoidance legislation that would seek to say that the American will always be subject to tax on actual or constructive receipt of income from his participation in that foreign entity. Then moving on to effectively connected income, the US trade or business. So the whole key here is the pursuit of profit. So the general principles as to whether or not you've got effectively connected income is generated as to whether or not the profit earned or pursued. And from here the key words tend to be from a considerable, continuous, regular and substantial activity undertaken in the US. However, in personal service world, we need to be somewhat more cautious because levels of activity very quickly become a trade or business or employment activity for US domestic purposes. And where we have partners in a partnership, the active solicitation which rises to a point of actually achieving fees and service delivery in the US, of course, brings you fully into the fledge of effectively connected income and taxable income. Just a final point at this stage before I hand over to Andrew to look at some of the personal stuff, and that's with fixed determinable annual and periodic income. There's there's a whole range of non-trade type sources which can attract US tax, from dividend, interest, all the way through in terms of activity, which of course can be overridden by treaty, but that's your starting principle in terms of domestic concerns. So Andrew, over to you.
Thank you, Mark. Hi everyone. So as Mark said, I'm going to just talk through the tax impact that setting up in the US or changing your US structure might have on the principles of your business, because obviously whenever you are moving into a new venture, you want to know what impact from a tax perspective that might have on them. So probably the first question, if you have senior individuals in your business, whether they're employees or partners, who are going to be spending time over in the States, is will they become US residents for tax purposes? Because as soon as you become a US resident, you're subject to US taxes on your worldwide income and capital gains, so it could have quite a big impact. And there are two ways that an individual can become a resident in the US for tax purposes. The first is if they obtain a green card, then they are immediately a US tax resident. And the second is if they meet the conditions of the substantial presence test. And the substantial presence test, I'll try to make it as simple as possible. You basically take the total days that an individual has spent in the US in the current year, and you take 1/3 of the days in the prior year and 1/6 of the days in the year prior to that. And if that total comes to more than 183, then they are a resident for US tax purposes under domestic US law. Now, one of the things that we advise on regularly is where people are splitting their time between the US and the UK, which is obviously fairly common when a business is setting up in the US, is whether they would remain tax resident in the UK. And obviously we don't have time to talk about the UK rules today, and that's not what we're here for, but they are quite complicated, and it's very difficult. It can be very difficult to break UK tax residence if you're still spending significant amounts of time here. So where somebody is actually resident in the UK and also in the US under each country's domestic law, then we then turn to the double taxation agreement between the two countries, and that applies a series of tests, and generally you look to which country does that individual have the closest ties to, where are their family, where's their primary business location, those kind of things. And often, even if somebody does meet the substantial presence test because they're spending so much time in the US, if they remain resident in the UK and their family are here, we can use the double taxation agreement to actually protect them from becoming US residents. So that's something we advise on a lot. Final point on this slide is that every US state, well, sorry, there are a few that don't have an income tax, but those that do, they each have their own rules on residence, and we could probably talk all day about different residency rules in the States, but suffice to say they're not the same as the federal rules, so you need to think about state taxes whenever an individual's spending time over in the US. So once an individual or somebody's determined whether or not a partner or a principal in your business is a resident or not, what's the actual tax impact for them? Well, if you have a structure, and Mark will go into the detail on a few common structures that we see shortly, but depending on what structure you set up in the States, you might have partners in a US entity who are not resident in the US, they're non-resident aliens as they're referred to. And where you have that, if the US business is generating effectively connected income, as Mark was talking about earlier, then to the extent that that is allocated to non-resident partners, the firm needs to withhold tax on that. And the tax rate is the top rate that's in place at the time, which at the moment for federal tax purposes is 39.6%. The partnership has to actually determine who is a non-resident alien and who is a resident alien, and the way they do that is that they ask all the partners in the US partnership to provide them with either a Form W-9, which is the form to certify that you are a US resident, or a Form W-8-BEN, which is the form to certify you are a non-resident alien. So even to complete those forms, obviously you need each partner who is a member of the US entity needs to self-certify, so they need to know whether or not they're a resident. Because the rate's 39.6%, generally what you find is that partners are due a refund when they file their tax return, because the actual tax rates in the US are there are marginal rates, which you don't actually pay 39.6% till around $250,000 of income. I guess a step back is to say that there is no mechanism to file a composite federal return in the US for your non-resident alien partners, so every partner who is receiving a share of effectively connected income has to file a tax return, unlike that's different to the UK, obviously, where you can file a composite return for your non-resident partners. So what do the non-resident alien partners have to do? As I said, they have to file a return every year that they receive effectively connected income. That return is due by the 15th of June. You can file an extension to October 15th, and that's automatic if you want to do that. Each partner will need a taxpayer ID number in the US. Now, if they have a visa, so they have immigration status to go to the US and live in the US, then they can get a social security number. If they don't, so if they are just non-resident aliens, they go over there on their business visa or a visa waiver, then they have to get what's called an individual taxpayer identification number, or ITIN, which I'm sure many of you have come across. The ITIN requires you to either send your original passport or to the IRS so that they can give you the ITIN, which obviously most people are quite not keen on doing. So there is a process where you can use something called a certified, or somebody I should say, called a certified acceptance agent, and they are people who have been authorised by the IRS to certify documents on their behalf. And there are a number of those in London. BDO has one as well. So yeah, if your non-resident alien partners are also UK resident and UK domiciled, then obviously they're going to continue to pay full UK tax on their worldwide income, but they would be able to claim double tax relief for the US tax that they're paying. One of the issues that we see fairly regularly when people are opening a new venture in the US is that a partner's UK profit share might be replaced or partially replaced by a share of profits from the US firm, and because those profits are subject to withholding and US taxes, you need to make sure that, or try and ensure that their UK payments on account are adjusted accordingly, because otherwise you will find that your partners are out of pocket, albeit temporarily, but they will be. Just a brief word, if I can, on Social Security, because it's quite a complex area, and again we could have another hour or so session on Social Security alone, but if you have a US entity that's wholly trading outside the UK, so it has no activities at all in the UK, then the partners of that entity should not be subject to Class 4 national insurance on their share of the profits. But that's a potential benefit. So if your partners or senior employees are going to become resident aliens and they are not going to be able to use the double taxation agreement to protect themselves from US residents, then it's really important that they review, or somebody reviews, their personal investments and just their circumstances in general to make sure that they're not going to fall foul of any of the anti-deferral rules in the US, which can create issues. The other thing that's important is to review the status of the UK entity. If they're going to continue to be partners in that UK entity, what is that entity for US tax purposes? Because there are some surprises that can be thrown up. For example, a UK LLP, because there is no partner with unlimited liability in an LLP, would often default to be treated as a corporate entity in the US, and that can cause some issues, and in fact it's often beneficial to elect to treat that LLP as as a partnership instead, so that the two marry up. Again, very briefly, Social Security, generally payable in the country where the partner is habitually resident. So in some circumstances, if a partner is only going to the US for a temporary period, you might be able to apply for a certificate of coverage so that they can continue to pay UK national insurance rather than US Social Security. And just the rates aren't particularly different, but from a personal perspective, lots of obviously UK citizens, UK residents prefer to carry on paying national insurance as opposed to US Social Security. A couple of other things that we commonly advise clients on is pension and benefits policies when you're moving people overseas. Do they want to move into do you want to set up a local pension provision for them or keep them in their UK pension? What do they want to do, and what works best from a tax perspective and a financial perspective for them? We commonly see, particularly for shorter term secondments and moves, we commonly see firms employing tax equalisation agreements. So they will say to a partner or an employee, we will guarantee that you pay no more tax than you would do in your home country. And then, as I said earlier, it's very important that anybody who is going to the US make sure that they review their personal investment portfolio to ensure that they're not going to find themselves paying punitive rates of tax on that in the US. So, and as I said, I'm now going to hand back to Mark to talk a bit more about the kinds of structures that we commonly see.
Thanks, Andrew. So I'm going to start off looking at, the first steps, if you like, in moving and recognising that you've got effectively connected income and moving into the US, and the formation of a branch. So a branch is taxed as a division of its parent, and registration is relatively straightforward and can be done at a state and needing to be done at a state or local level. The branch will effectively pay tax on its effectively connected income, and typically in the opening years where there's losses involved, then that can be an attractive proposition in the context of repatriation effectively to the UK. It's essential that you keep adequate books and records, but by its very nature, essentially, as Andrew was talking about earlier, you've exposed the partners to federal and state filings in the context of the operations of the branch in the US. Secondly, we look at the UK LLP and its operations in the US. And I skirted over, although Andrew picked up on it, foreign partnerships and the key point about distinguishing a UK LLP as to how it's treated in the US. So just going back to that, just importantly for a minute, if all the members have limited liability, then for US purposes, the UK LLP would be classified as an association, i.e. taxed as a corporate. So, as Andrew touched on, the rules allow the partnership to effectively elect to be out of that default position to be treated as a partnership. So we're often running. We've got a UK LLP regarded as a transparent entity for US purposes. But in the scenario 2, we've got each partner effectively has an engagement in a US trade. So we've got a fixed place of business for the entity in the United States. And there we have the full ramifications of federal and state filings to worry about. We've got consideration to the extent we've got effectively connected income of withholding tax obligations on the foreign partners in the US at the highest rates, as Andrew commented on. So we've then got things like revenue rulings in the IRS 9132, which states and has the presumption that if there's gains realized, and we've got this mixture of US and foreign source, and it's not clear to determine, the IRS will point to the fact that it's US first. So that isn't always a great thing, a great position to be in. So you're likely to have a higher effective rate of tax as a result. Then we've got corporate structures, and we talked about LLCs earlier. And the LLC in the US context, in a purely domestic sense, is a great proposition, very effective, and we talked about the flexibility in terms of the management of how it operates, and the fact that it's taxed as a partnership in the US. However, in an international sense, and it's not just the UK, but the practical uses can be quite limited. You've got challenges on the extraction of profits, given that the LLC for UK purposes is considered an opaque corporate entity and not a look-through. For corporates, it can work quite well where you effectively check the LLC to be regarded as a corporate and then have suitable flow. But for professional services firms, generally we're faced with that challenge in terms of looking at matters. So a couple of other ideas which we see and some folks I think have are essentially the umbrella structure where you have in this case the UK and the US, but it can be on obviously on a much wider basis, the formation of a global governance entity to effectively oversee and have an involvement in what the partnership is doing. The important difference here is that we've got no common partners between, in this case, the UK and the US. We have partners sat in the two respective entities. We have no concept of global profit share between the partners. And then essentially to make the whole thing function, we've got the question of inter-firm services and things to look at. So typically you'll have some cost sharing through a separate entity that's created to effectively manage that function between the different entities. But essentially you've got to keep the delineation and clarity of the respective shares and the respective partnerships. And there are some challenges with lockstep type partnerships in making these things work. So an alternative is the use of parallel partnerships. So we have a UK and US partnership sat alongside one another. And here, and the idea behind this is you're attempting to try and limit the personal liability of individual partners or the number of those on a cross-border basis and the necessity of filings. So essentially you put a few partners in the US firm, in the context of a UK business looking to the US, and those partners are used effectively as a bare trustee to allow the income flows to the UK firm's partners as a collective. However, if you've got a global profit share mechanism, and especially if there's some global control over the operations, the IRS are likely to say, well, we've got a global pot here, and their view is likely to be, that it's all one, and all the challenges that go with that. So the next question is whether or not you can use the valve partner solely as a mechanism to the individual tax filings. And then, so in looking at that debate, you've got, in a global profit share arrangement, the valve partners in the firm, which is effectively drawing the most income, they take more of the pot first to balance the global pot. And I have to say that opinions vary considerably on that, and maybe we'll come back to that a bit later on. So. A couple of other points to look at. One thing that everyone's needing to be very aware of as we move forward is in November 2015, a new act was signed into force, the Bipartisan Budget Act 2015. And what that brings about, not right now, but by the end of 2017, is a new regime for dealing with federal tax audits of partnerships. And absent electing out, which I'll touch on in a minute, the new rules impose, and you remember I talked earlier about aggregate and entity, it will impose the adjustments following a tax audit at an entity level. So all of the adjustment and the penalties and interest will be imposed at the partnership level. There are a few exceptions. Small partnerships are accepted out where they elect, and there's 100 or fewer partners. Tiered partnerships will, as I understand it, not be eligible to elect out. And the mechanics effectively will flow through, in terms of debates between the IRS and the partnership, with the possibility that at a certain point you can make a push-out election, effectively pushing the liabilities out from the partnership to the individual partners. And that comes with strings attached in terms of requirements to issue statements that are furnished to all the partners with regard to them fulfilling that obligation. And that all it says at the moment is that that's dealt with within a reasonable time frame. The other key change here is in relation to, at the moment, not all partnerships have them, but where they do have, there's a tax matters partner that effectively represents the partnership in the negotiations with the IRS. This tax matters partner is replaced under this new procedures by a partnership representative. That partnership representative actually doesn't need to be a partner, so a bit like characterizations in LLC, it could be some other management person. But they will have sole authority to act on behalf of the partnership in the audit dealings. So very much a move by the IRS to try and speed up and focus the way they deal with audits and partnerships in the States. And then finally for this section, I was going to touch on a development in relation to LLCs. So this is the ANSON case, which I'm sure everyone's heard about. And this was all around the UK treatment of the LLC, so the US LLC that we've talked about this morning. Now, the revenue have got a long-standing practice to treat that as opaque or corporate for UK purposes. And hence, you've got a real challenge where you've got UK resident partners who are members and participating in a US LLC operating as a partnership for US purposes. So let's look at the facts of Mr. Anson for a minute. So Mr. Anson was a member of a Delaware LLC. It was a private equity establishment, actually. He suffered US tax on his share of profits, and then the after-tax income paid to him essentially as a distribution. He claimed, whilst there was a reflection from the HMRC that would be a dividend for UK tax purposes, he claimed double tax relief under the treaty, saying, why am I going to be doubly taxed on this? The revenue refused, as they essentially said that it did not arise, the dividend or the distribution did not arise as the same income, i.e. it effectively received a profit distribution, profits interest in the LLC, and it made a subsequent distribution, which was a dividend as far as the revenue was concerned. No basis under the treaty or otherwise, in their view, to give him credit. So this case went backwards and forwards, ultimately ended up in the Supreme Court. And the argument was concluded both on, and very much on specific facts. In other words, it was both the fact that the Delaware legislation and the members' agreement in this particular case came to the conclusion that the profits belonged to Mr. Anson as they arose, which was pretty key as far as he was concerned, because magically we suddenly didn't have a separate distribution to be treated as a dividend. He had something that effectively had a right when it came out to him. So where are we now? We might talk about that again in a minute, but certainly the revenue came up with a statement. So that was July 2015. In September 2015, the revenue came up with some commentary on this, and they effectively said, well, nothing's changed as far as we're concerned. The case of Mr. ANSON was very specific, and our general view of life would be that, well, certainly it's still opaque for UK purposes, and that you'd look to the individual agreement. So nothing's changed, which for corporates was a relief in some ways, because they'd always taken the view that they checked the box on LLCs where it was a UK corporate entity, and they could be assured there was no corporate tax liability on undistributed profits, and that dividends would typically flow back to them in the UK without challenge. So that's Mr. ANSON.
Very good. Well, thank you very much, both. That's the end of the main presentation. We've got a couple of questions, but you've probably covered a couple of the points already, so maybe a little bit more flavour on some of the points. One of the questions is really following on from your points that you've made about the ANSON case, and what that really might mean going forward for LLC situations in the future, given HMRC's statement, as you mentioned, in September. Is there anything else that you can add, or is it literally wait and see?
Well, I mean, I think there's some sense with some cases to actually having a close examination of the agreement and seeing whether or not a case similar to the one that Mr. ANSON was able to put together can be used in some cases, or indeed in future construct, whether or not it works for in the LLC setup to effectively design it so that there can be little argument that there's a flow through directly to the UK partners. So I think primarily where you've got UK participants in a structure and you perhaps want to look at an LLC as a suitable mechanism, you could start by looking at, you know, let's say Delaware, let's say the members agreement would look to mimic ANSON. But I think certainly in terms of the revenue are probably right as far as existing structures are concerned, that by and large this challenge still remains.
Yeah, so very much look at the situation you've got an opportunity to plan, then let's see how we can structure something at the outset to get the outcome that we would prefer. Yeah. Okay. And just a question on valve partners also, in terms of the risk that you mentioned that the US IRS would consider all of the partners worldwide, where you've got a parallel structure perhaps being subject to tax in the US. How real is that threat, and what do we do about it? There's a smile at this end of the phone.
Yeah. Well, I think there really is a debate about the IRS's attitude to it. I think the IRS do have some questions about whether it works or not, but I think it starts from a premise of how aggressive you're being in the operations. So, you know, if the operating profit in the two businesses is robustly being addressed, and you are effectively using this mechanism only to limit the administrative exposures of the whole group of partners, then your argument is far stronger than if you're perhaps if there's a suggestion that there's a manipulation of profit and therefore the IRS is losing out one way or another.
Okay, so again, another point of being really clear about what your intended outcome is. And I guess like in the UK, what we do is actually document a lot of what our own views are and how we've got to that conclusion in order to have a position to start with in terms of the conversation.
Absolutely, yeah.
Okay, and then the final question around US state tax, and I know you've mentioned US state taxes throughout both of your presentations and the complications there, but how does the US state tax system interact with the federal tax position?
Well, either of us are going to take this as a problem. I think that one of the points that we've concentrated on the federal side of it. What's absolutely important in planning and thinking about structures is whether or not the business has a nexus in a particular state, and I think that's a subject on its own. And each state has varying rules on this. So the state is key and important, and certain states have particular challenges where, I suppose, Andrew talking about the foreign tax credit and the ability to take a relief. You know, classically, California is a big state in which they pay no attention to the treaty, and there's certain other states that do the same. So the presence of your employees and partners in particular states, when you start to do business, it's that leakage potentially into terms of doing business in different states, which will produce additional challenges to you in terms of managing your tax exposures overall, and actually the question of your effective rate.
Yeah, I think the most important point, Mark, was that most US states do not recognise the federal tax treaty between the US and the UK, and as of now, there are no US states that have their own tax treaty network with anywhere in the world. So you can end up in a situation where you may be able to claim to be non-resident for federal tax purposes under the treaty, but one of the states might say, well, under our rules, you're a resident here, and then you could end up in a situation where you're paying UK tax on your worldwide income plus US state taxes. And if it's California, which is the example Mark gave, then that's potentially 11, 12% tax on top of your UK tax liability. So you need to be very careful with states and not triggering residence if possible.
Yeah, so it sounds like there's no easy answer to that. It's looking at each state and planning where you may want to be if you're setting up in the US, and as you mentioned, Mark, how many states you actually want to be in, and understanding the impact of that.
Absolutely.
Okay, well, thank you both very much for your insightful words. There's a lot more complexity behind that, and these are the things that you regularly look at. In terms of next steps, we will be sending an email, as I mentioned, with the slides and the recording of the webinar in the next few days. And if anyone does have any further questions, then please don't hesitate to contact us to ask them of Mark or Andrew. Thank you all very much for listening, and that's the end of our webinar.